Welcome to this Talk Tickers Deep Dive.
Glad to be here.
So today we are zeroing in on a company that is, honestly, attempting one of the most difficult maneuvers in corporate history.
Oh, absolutely. It's a massive pivot.
Right. We're looking at Booz Allen Hamilton, ticker symbol BAH. And the numbers here are wild.
They really are. It's like watching a financial paradox play out in real time.
Exactly. I mean, think about this. They just fired roughly 12% of their workforce.
Yeah, a huge cut.
And they saw their gross revenue drop by nearly 7%. But somehow, their profit margins are soaring.
Right. Earnings per share spiked double digits. Wall Street is definitely paying close attention to this.
So for the listener, our mission today is simple. We are going to cut through the federal procurement jargon, look at the raw data from their Q4 fiscal year 2026 earnings call, and give you an actionable verdict.
Is this defense tech giant a buy, a hold, or a sell?
Exactly. And this is a 100-year-old government body shop, founded in 1914.
Yeah, a legacy consulting firm. They traditionally made money just by putting smart people in government seats and billing by the hour.
Right. But now they are shedding headcount while expanding margins, turning into an AI-driven tech company.
It is the ultimate paradox. And this Q4 earnings call is basically the blueprint of this entire transformation.
Okay, let's unpack this, because I was looking at the balance sheet for the fourth quarter, and the contradiction is just jarring.
It really jumps off the page.
Q4 gross revenue came in at $2.8 billion. That is a 6.4% decline year over year.
And if you exclude billable expenses, the top line was actually down closer to 7%.
Right. They're objectively bringing in less money than they did at this exact time last year.
But then you slide your finger down to the bottom line.
Exactly. Q4 adjusted EPS, earnings per share, hit $11.78, which is actually up roughly 11% year over year.
Yeah, and the margins expanded too. Adjusted EBITDA margin hit 11.1%.
An increase of 50 basis points. So I have to ask, how does a company report a 7% drop in quarterly revenue, but an 11% increase in earnings per share?
It's the multi-billion-dollar question.
Are they just doing less work, but somehow charging the federal government a massive premium for it?
Well, to really understand that dynamic, you have to look at the mechanics of the balance sheet.
Okay, what are the mechanics here?
Their new chief financial officer, Troy Lahr, outlined 4 specific levers that drove this.
Let's go through them. What's lever number 1?
So the first lever is a significantly lower tax rate in the quarter.
Lower taxes. How did they pull that off?
It was driven by higher R&D tax credit.
R&D credits for a consulting firm.
Right. Historically, a staffing-heavy consulting firm does not generate massive R&D tax credits.
Because their product is human labor.
Exactly. You cannot claim an R&D credit for a consultant writing a policy memo for the Pentagon.
Yeah, that makes sense. So what changed?
Well, Booz Allen is heavily investing in building proprietary software and AI products now.
Oh, wow. So they are reaping the tax benefits of a traditional Silicon Valley tech firm.
Precisely. That structural shift in taxation is a massive tell.
Yeah, I mean, the IRS Section 41 credit requires a company to prove they are engaging in a process of experimentation.
Right, to resolve technological uncertainty.
So if Booz Allen is suddenly qualifying for these credits at a scale that moves the needle on their quarterly EPS,
it means they've transitioned a huge chunk of their workforce from standard IT maintenance into actual software development life cycles.
they are capitalizing software development costs. That completely changes their margin profile compared to a pure services firm.
It does. And, it also changes how they bid on future work.
How so?
Well, when you develop proprietary IP, you own the underlying technology. You are no longer just selling hours.
You are selling a licensed solution.
Exactly. Which leads directly into the second lever padding that EPS number.
Okay, lever 2.
A reduced share count. They deployed $147 million in the fourth quarter alone on shareholder returns.
Wow, $147 million. Does that include the dividend?
It does, but it leans very heavily into share repurchases.
The signaling effect there is fascinating to me.
Oh, absolutely. Buying back shares during top-line contraction.
Right. Usually when a legacy company sees revenue shrinking, they hoard cash, they protect the balance sheet.
Yeah, they don't usually spend $150 million to retire shares.
So that tells me management believes the stock is deeply undervalued relative to the margin expansion they see coming.
Exactly. By shrinking the denominator, the number of shares outstanding, every remaining share gets a larger slice of the pie.
A larger claim on the future profits of these new AI products.
Exactly. Okay, so the third lever driving the bottom line beat is a $12 million pre-tax unrealized gain.
Unrealized gain from what?
related to their ventures portfolio, Booz Allen Ventures.
Okay, I saw this. They deployed, $219 million in the fourth quarter?
Yeah, across strategic investments and venture partnerships, taking equity stakes in early-stage defense tech, AI, and space companies.
So when the valuation of those external startups increases, Booz Allen records an unrealized gain on their books.
Right, and that added about 11 cents per share to their adjusted EPS for the full fiscal year.
I mean, I want to push back on the sustainability of that 11-cent bump, though.
Fair enough. It's definitely volatile.
Yeah, unrealized venture gains are incredibly volatile. Playing the role of a venture capitalist in the defense sector is high risk.
Oh, for sure. The Department of Defense procurement cycle is brutal.
They call it the Valley of Death, right? The phase where startups have a great prototype but cannot secure a production contract.
And they just bleed cash until they die.
Exactly. So how is Booz Allen mitigating that risk? Or are these venture gains just a lucky quarter padding the EPS?
Well, management explicitly stated in their forward guidance that they assume zero impact from strategic venture investments going forward.
Oh, okay. So they aren't relying on it.
Right, because they are impossible to predict. However, the strategic value of Booz Allen Ventures isn't really about financial returns.
What's it about then?
It is about integration rights. Startups in the defense space often lack the clearance and the bureaucratic skills to sell to the Pentagon.
Yeah, the red tape is insane.
Exactly. They lack the established contract vehicles. So Booz Allen acts as the bridge.
Ah, I see. They take an equity stake, integrate the startup's cutting-edge tech into their broader solutions.
And sell it through their existing massive contract vehicles.
That is brilliant. So the $12 million gain is just a nice accounting bonus.
Right. The real value is pipeline acquisition.
It makes the venture arm function almost like an outsourced R&D department.
Exactly. But taxes, buybacks, and VC gains still cannot account for all of the margin expansion.
No, getting to an 11.1% EBITDA margin in federal contracting requires severe operational discipline.
Yes, and CEO Horacio Rosansky mentioned significant delayering over the past year.
Delayering, that's the fourth lever.
That is the fourth and honestly the most critical lever. They executed a cost takeout target of $150 million on an annualized basis.
$150 million in overhead.
Yep. In a matrix consulting firm, administrative layers board up over decades.
So stripping up that middle management makes the business leaner?
Precisely. And because of federal cost accounting standards, contractors have to allocate overhead very carefully.
Right. The government monitors all of that.
Exactly. Generally, they get to keep about 40% of those cost savings as pure profit margin.
And the other 60%.
That lowers their wrap rates, making them more competitive on pricing for future bids.
Let's talk about the wrap rate, because lowering that is crucial.
It really is the lifeblood of federal pricing.
For the listener, the wrap rate is essentially the multiplier applied to an employee's base salary to cover overhead, fringe benefits, and profit.
Right. So if you pay a guy $50 an hour, the government might be billed $120.
Exactly. So if Booz Allen strips out $150 million in overhead, their wrap rate drops.
They can bid lower on competitive contracts while simultaneously keeping a larger chunk of the profit margin for themselves.
Wow. So when you combine a leaner corporate structure with lower taxes, fewer shares, and venture gains,
the paradox of shrinking revenue and booming profits makes complete mathematical sense.
It really does. And for the full fiscal year 2026, they delivered $11.2 billion in gross revenue.
Along with $6.51 in adjusted EPS.
And a massive $951 million in free cash flow. Nearly $1 billion.
Yeah, generating that kind of free cash flow during a transitional year proves the financial model is incredibly resilient.
But the top line growth is stalling.
Yeah.
And to understand why, we have to look at the massive bifurcation happening inside the company.
It really is a tale of two completely different businesses living under one roof.
Let's look at the anchor currently weighing down the ship. The civil portfolio.
Right, the non-defense side.
Exactly. This division consults for agencies like Treasury, Health and Human Services, Homeland Security.
And in Q4, revenue for the civil business plunged an astonishing 23% year over year.
23%. If any standalone company reported a 23% drop in quarterly revenue, Wall Street would hit the panic button.
Oh, without a doubt. It is a staggering decline.
So what drove it?
A combination of tough comparisons to past performance and fundamental shifts in procurement behavior.
They mentioned massive roll-offs from legacy contracts on the call, right?
Yeah, specifically citing the Pintum's contract ending and run rate reductions at the Department of the Treasury.
Okay, but contract roll-offs are a normal part of the federal cycle.
They are, but President and Chief Operating Officer Christine Martin-Anderson highlighted a more systemic dynamic.
The government is changing how it buys.
Exactly. When massive 10-year IT modernization contracts come up for recompete, they are no longer being awarded as monolithic blocks.
Right. Procurement officers are breaking them down into smaller scopes with shorter periods of performance.
Because the government has grown terrified of vendor lock-in.
Makes total sense. Historically, they would hand a single contractor a 5-year, $500 million vehicle to overhaul a database.
And if the contractor underperformed in year 2, the government was just stuck.
But now, agencies are adopting agile procurement methodologies.
Yeah, they will issue an 18-month, $50 million contract to deliver a specific minimum viable product.
A sprint. And if the contractor succeeds, they win the next sprint.
Exactly, which is fantastic for the taxpayer, honestly.
But it creates a brutal revenue environment for legacy contractors.
Because they rely on massive, guaranteed, multi-year revenue streams to forecast growth.
Right. It severely degrades the predictability of their backlog.
Plus, budget uncertainties at agencies like the Department of Homeland Security are causing officers to delay even those smaller contracts.
So the civil business is bleeding out because the era of the mega contract is dying.
Basically, yes.
Yet Horacio Rosansky sounded incredibly optimistic on the call.
He did, because the reason for the optimism lies on the other side of the house.
The national security portfolio,
which grew 1.6% in Q4.
Now, 1.6% doesn't sound like a boom.
No, but the 1.6% growth figure masks the actual momentum building in the pipeline.
Because in the fourth quarter alone, they won $1.7 billion of new work in national security.
Yeah, and the nature of these wins highlights the whole transformation story we're talking about.
Let's talk about the specific wins. They secured an OTA on a program called Golden Dome.
Right, to build a prototype system for space-based missile defense.
And they also won BEATS. BEATS.
Breakthrough Engineering and Advanced Technology Solutions.
A $937 million single award contract to support Army modernization priorities.
Massive win.
I really want to dig deeply into the Golden Dome OTA, though.
Yeah, OTAs are the key here.
Horacio mentioned they had a 90% increase in OTA proposal submissions and a 50% increase in OTA awards compared to the prior year.
For the uninitiated, OTA stands for Other Transaction Authority.
It's a special procurement mechanism that allows the Department of Defense to bypass the Federal Acquisition Regulation, or FAR.
And the FAR is a sprawling, red tape-heavy set of rules that governs traditional contracting.
Right. So when the DoD wants to act like a commercial tech company and fund rapid prototyping, they use an OTA.
Exactly. And OTAs fundamentally alter the margin profile of the work.
How so? Because traditional government contracts are often cost plus, right?
Yes. The contractor states it will cost a certain amount to pay their engineers, adds a predetermined profit fee, and bills the government.
So the only way to increase gross profit dollars in a cost plus model is to hire more engineers and bill more hours.
Exactly. It incentivizes the contractor to operate as a giant body shop, prioritizing headcount over efficiency.
It's the mechanic analogy.
Right. Let's break that down for the listener.
If you pay a mechanic $100 an hour to fix your engine and it takes 10 hours, you pay $1,000.
But the mechanic has zero incentive to invent a new diagnostic tool that finishes the job in 2 hours.
Because if he finishes in 2 hours, his revenue drops to $200. He loses money by being efficient.
Exactly. But an OTA is often tied to an outcome-based or fixed price structure.
The government says we will pay you $1,000 for a working engine.
And if the mechanic uses a new proprietary tool to finish the job in 2 hours, he still gets the $1,000.
And his profit margin skyrockets.
Exactly. The workforce data from the Q4 transcript perfectly illustrates this mechanic analogy playing out at an enterprise scale.
Headcount dropped 12% in the quarter.
Yet revenue per employee increased 6%.
That is wild. They are actively decoupling revenue growth from headcount growth.
They are shifting from being a labor-reliant firm to an intellectual property-driven firm.
Firing or losing 12% of the workforce while increasing the revenue per remaining employee by 6% is the tech pivot in pure mathematical form.
Yes. If Booz Allen deploys proprietary software to complete a space defense analysis in half the time it used to take a team of 20 analysts.
They keep the extra profit under these outcome-based contracts.
This is exactly why management is willing to endure the top-line contraction.
The quality of the revenue replacing the old labor hours is vastly superior in terms of margin.
And the tip of the spear for this transformation is their investment in artificial intelligence.
Specifically in the cyber domain, right?
Yeah, Christine Martin-Anderson dedicated a significant portion of the call to discussing agentic AI.
Agentic AI. That is a critical distinction from the generative AI most people interact with today.
Oh, a massive distinction. A generative model like ChatGPT answers questions or summarizes text.
Right, but an agentic model takes action.
Exactly. It executes multi-step plans, reasons through obstacles, and acts as an autonomous agent within a system.
So how is Booz Allen monetizing this level of autonomy in federal cyber defense?
They are building automated cyber warriors.
Automated cyber warriors.
Yeah, they discuss a suite of products called VELOC, designed for agentic cyber defense.
And the demand from both federal and commercial customers was so intense that they actually compressed the development timeline.
They fast-tracked the release into the first half of this year, rather than the originally planned 18-month horizon.
The technical architecture required to deploy agentic AI in a defense network is staggering to think about.
Oh, it's incredibly complex. The DoD operates under strict zero-trust principles.
Right, so getting an authority to operate, or an ATO, for a piece of software that autonomously makes decisions and alters network configurations.
Without a human in the loop, it's a bureaucratic nightmare.
So how does the VELOC suite actually function within the cyber kill chain?
They detailed a system called Mythos, which operates alongside the VELOC suite.
Mythos, what does it do?
Mythos mimics an advanced AI-enabled cyber attack. It automates red teaming.
Red teaming, like penetration testing.
Exactly. In traditional cybersecurity, a team of human analysts attempts to penetrate a network to find vulnerabilities.
Which is slow, expensive, and limited by human cognition.
Right. Mythos automates that entire process, launching continuous agentic attacks against their own systems to map the attack surface dynamically.
Wow. So they were basically building the AI virus and the AI vaccine simultaneously.
Exactly. Mythos maps the vulnerabilities through autonomous attack simulation, and VELOC deploys the autonomous countermeasures to patch or defend those vectors.
And because they are selling licensed access to this software suite, rather than sending 50 human analysts to sit in a windowless room at Fort Meade,
the profit margins expand exponentially.
And they are expanding this capability aggressively. They recently acquired DeFi security, right?
Yeah, to strengthen their ability to scale these commercial cyber product sales.
The transition from human in the loop to human on the loop, and eventually human out of the loop, is the defining shift in cyber warfare.
And Booz Allen is clearly positioning itself to own the software infrastructure that enables that shift.
Okay, but transitioning an $11 billion legacy business into a software-first defense tech company requires immense near-term pain.
It definitely does. It's not going to be a smooth ride.
Right. When a management team tells you the future is bright, but the next quarter is going to hurt, you have to read the fine print of their guidance.
And their forecast for fiscal year 2027 is incredibly nuanced.
Let's break down the guidance. They expect FY 2027 revenue to land between $11.2 billion and $11.7 billion.
Which is essentially flat to slightly up from the $11.2 billion they just delivered.
Flat revenue guidance is a really tough pill for the market to swallow when the whole narrative is centered on a high-growth tech transformation.
True. But the bifurcation we talked about remains the underlying story here.
Right, because they project the national security portfolio will grow in the mid-single digits.
While the civil business is expected to decline in the high single digits for the full year.
And management explicitly warned that Q1 will be the low point for growth.
With sequential improvement expected throughout the year. So the first half is going to look ugly.
The civil business is facing steep comps, meaning the performance will look terrible compared to the elevated revenue levels of the previous year.
Before the mega contracts rolled off.
Exactly. But beyond the comps, Rossy Rozansky reminded everyone that this is an election year.
Which introduces severe macro volatility into the federal contracting space.
Election years routinely wreak havoc on federal budgets, regardless of the political environment.
Congress is often distracted, or they're reluctant to pass long-term appropriations before a new administration or a new congressional majority takes power.
And that inevitably leads to continuing resolutions, or CRs.
Which contractors hate.
Let's explain why. A continuing resolution freezes government funding at the previous year's exact levels.
It prevents a government shutdown, but it completely paralyzes new procurement.
Right. If you are a contractor trying to win a massive new contract for cutting-edge space defense, A CR is devastating.
Because no new money can be authorized for new programs.
Procurement officers become highly risk-averse during a CR.
They delay awarding new contracts because they lack clarity on their final budget authority. The funding environment becomes fluid and choppy.
Now, management noted that the funding pace has improved since January compared to the pre-shutdown fears of late 2025.
But they are still baking significant election year volatility into their guidance.
Okay, so revenue is flat, Q1 is projected to be rough, and elections make budgets choppy. But the most debated piece of the guidance is the profitability forecast.
The EPS guidance.
Yeah. Troy Lahr guided FY 2027 adjusted EPS to be between $6 and $6.35.
Right.
So wait, if the tech pivot is working, if they are keeping 40% of their cost savings, and if margins are holding steady at roughly 11%.
Why is the EPS guidance for 2027 lower than the $6.51 they just delivered?
Exactly. Is management intentionally sandbagging to lower Wall Street's expectations? Or is the contraction in the civil business so severe that it is wiping out the margin gains from the tech pivot?
It's a mix. But first, the baseline for comparison requires an adjustment.
What kind of adjustment?
The $6.51 from last year included that 11-cent bump from unrealized venture gains we talked about earlier.
Oh, right. The Booz Allen Ventures gain.
And management's new guidance of $6 to $6.35 assumes zero impact from strategic venture investments.
Okay, so stripping that out for apples-to-apples comparison sets the true baseline at $6.40.
However, even against $6.40, the guidance still implies an earnings contraction.
Which brings us to the core tension of self-funded investment.
Horatio and Troy repeatedly emphasize that they are plowing money back into the business.
They are organically and inorganically investing to accelerate their cyber and defense tech vectors.
Injecting AI directly into their own infrastructure.
So they are actively choosing to sacrifice short-term earnings per share to build the IP portfolio out of their own pockets.
Exactly. A highly profitable company generating nearly $1 billion in free cash flow has choices.
Sure. They could easily slash their internal R&D budget,
halt the development of the VELOC suite, write out their legacy consulting contracts, and deliver $6.70 in EPS to trigger a massive short-term rally in the stock.
but that would be strategic malpractice.
It would be. They recognize that the Department of Defense is systematically shifting away from buying consulting hours
Toward buying outcome-based tech products.
And if Booz Allen doesn't build those products today, they will be obsolete in 5 years.
They are absorbing the margin hit of R&D investments now to ensure survival and dominance in the next decade.
Let's also look at the cash flow guidance, because that's important context here.
Okay. They guided free cash flow at $825 million to $925 million.
But there's a massive footnote regarding the IRS.
Oh, right. That range excludes a previously disclosed $170 million IRS refund that they originally anticipated receiving this year.
The timing has shifted, and they now expect it in fiscal year 2028.
So it artificially lowers the cash flow optics for the current year, but it's purely a timing issue, not lost capital.
Right. They also outlined planned capital expenditures for a new headquarters in Reston, Virginia, which will draw down cash in the near term.
Okay. So when you synthesize all these data points,
Right.
the guaranteed rocky Q1, the civil business contraction offset by national security growth,
The fundamental shift from billing hours to licensing AI products, and the intentional EPS hit to self-fund future IP.
you have to construct a very specific strategy for navigating this stock as an investor.
Absolutely.
And we promised an actionable, opinionated breakdown of whether BAH is a buy, hold, or sell.
What's the talk ticker's verdict?
Based on the Q4 data, our stance is cautiously bullish for the long term, but a definitive hold for the short term.
I agree. The horizon line dictates the strategy here.
We are bullish long term because the transformation from a headcount-reliant cost-plus consulting firm into a high-margin, outcome-based defense tech powerhouse is mathematically proven to be working.
The 11.1% EBITDA margins and the 6% increase in revenue per employee while shedding 12% of the workforce is the empirical evidence of that transformation.
They have successfully begun decoupling revenue generation from labor scaling.
Furthermore, they are protected by a $38 billion backlog.
The backlog is the ultimate safety net in federal contracting.
A $38 billion backlog represents contracted, funded, or soon-to-be funded work already secured in the pipeline.
So even if the new award environment freezes completely during the election cycle, they have years of executed contract value to draw down on.
But the short-term reality is messy. The civil division's 23% decline is a massive anchor on top-line growth.
And the $6 to $6.35 EPS guidance proves the transition will cause near-term financial friction.
They're ripping off the Band-Aid in the middle of a volatile election year.
So the actionable advice is clear. If you already hold the stock in your portfolio, maintain your position.
The AI and space defense upside is robust, and the dividend provides yield while you wait out the transformation.
But if you're looking to initiate a new position, you have to wait. Management handed the market a literal roadmap by explicitly stating that Q1 will be the low point.
Right. Buying today means buying into a guaranteed ugly earnings report in 3 months.
Let the stock absorb the impact of the first half of the year. Let it navigate the election cycle volatility and the inevitable continuing resolution headlines.
The optimal strategy is to look for a cheaper entry point in the late summer or fall, positioning yourself ahead of the anticipated second half recovery.
And the balance sheet provides the ultimate margin of safety for that strategy.
Yeah, Troy Lahr noted a net leverage ratio of just 2.6 times adjusted EBITDA.
Which means their debt levels are highly manageable relative to their cash flow generation.
Moreover, they possess $2.2 billion in total liquidity.
A $2.2 billion liquidity position is a massive war chest.
It guarantees they can survive any prolonged government shutdown, absorb the civil division declines without structural damage, maintain their dividend, and aggressively fund Booz Allen Ventures to acquire emerging AI startups.
The foundation is rock solid. The house is just covered in drywall dust from the renovation.
That's a great way to put it. Throughout this analysis, we have really tracked the collision of legacy government consulting and cutting-edge artificial intelligence.
We've examined how systems like VELOC and Mythos are designed to autonomously fight off cyber threats, moving the human out of the loop.
And as these agentic AI systems become smarter, as they learn to emulate attacks, automate the kill chain, and require less and less human intervention,
a profound question emerges for the entire federal contracting industry.
how long until the U.S. government simply stops buying consulting hours entirely?
Right. How long until the Department of Defense decides they no longer need 50 analysts sitting in a secure facility, and instead they simply demand to buy the software license?
It is the ultimate innovator's dilemma playing out in the federal space. Booz Allen Hamilton is racing against its own innovation, building the very technology that renders its historical business model obsolete.
And the multi-billion-dollar question is whether they will be the company successfully licensing that software at a massive premium, or the legacy consulting firm disrupted by it.
The numbers suggest they are successfully navigating the pivot, but the next 12 months will be the ultimate stress test.
Keep questioning the margins, monitor the divergence between headcount and revenue, and closely watch the adoption rate of their agentic AI platforms. Thanks for joining us for this deep dive.
See you next time.